Hello there, this is forexbrokers.net, and we continue the videos dedicated to double combinations. The first part of this article dedicated to how to trade double combinations dealt with what we need to consider in a complex correction such as this one. From a theoretical point of view, it's a lot of the entire theory is full of rules and relationships based on Fibonacci ratios between the waves and so on and so forth. And there's a big difference between how a theoretical pattern looks like and how you see things in reality on the currency market chart. As I explained earlier on the previous video, this is one type of a double combination. There are many types of double combinations. Most of them ends with a triangle, and the shape of the triangle is very important because it defines the price action to follow a double combination. If the triangle has, or if the triangle's apex points to the upside or to the downside, depending if the double combination is a falling one or a rising one, you may consider that the double combination is fully reversible or not, and so on and so forth. Now let's use a bit the euro US dollar example. This is the recent price action on the euro US dollar. As you can see, this is the last price. The recent price action on the euro US dollar since 2018, it was as high as 1.24, and then it simply declined on the chart. This is the daily chart, so every candlestick that you see here, green or red, represents one day. It is very important when you deal with the Elliott wave theory to answer one question at the start, right at the start when you look at the move. If you want to interpret this market move, the question is, do we look at an impulsive wave or a corrective wave? Well, it is obviously that at this point in time, we don't know if this is an impulsive wave or a corrective wave at this point. But the more that the market, or the more time passes, it becomes obvious that this is no impulsive wave. For an impulsive wave, you need to have a third wave extension, or a first wave extension, or a fifth one. 5 segments. There are no 5 segments here. So it becomes obvious that we should look for a simple correction, for a corrective wave. A corrective wave that sees a bounce, but if we use a Fibonacci ratio and measure the start of the move or the first segment and the end of the second segment, we see that the market bounced, failed to retrace more than 61.8 of wave A, and then made a new low. It implies a new low here. It implies that this is an ABC rather than 1, 2, 3, and this ABC can only be a zigzag because the B wave failed to retrace more than 61.8. That's a condition for a flat. Because the B wave didn't retrace more than 61.8, it must be a zigzag. In a zigzag, the time that it takes for wave A to form equals the time that it takes the C wave to form, as we laid down in other articles, part of this Trading Academy. So this ABC being a zigzag, we should apply the same principle we discussed on the previous video to see if this ABC is a simple correction. The thing to do is to measure the time that it took for the C wave to form, to project the time on the right side, and to expect for the market, to wait for the market to go and fully reverse the C wave in less or the same time. By the time the time passes here, it becomes less and less probable or improbable that the market has the power to go like this. So the chances are, or the Elliott wave trader already knows that a complex correction will form. An X wave should come. On a complex correction, or on expectations of a complex correction, a double combination forms not almost always, but many times. So this is the first thing to consider. Therefore, on a double combination, the next thing that follows after time expires is to find the end of the X wave. By the time that the market confirms that this is an intervening X wave, coupled with the fact that the B wave was unable to retrace more than 61.8 of wave A, makes this a 100% certainty that this is a zigzag. So you don't even need to go on the lower time frames to label or to find an impulsive structure, because implicitly the Elliott wave theory tells you that. The key then is to find the end of the X wave and to find a triangle at the end of a double combination. It is literally impossible to find a triangle here all these years from 2018 to 2020. For 2 years you may struggle finding something and you see that the market doesn't bounce. All this time probably you will be, as an Elliott wave trader, you will be tempted to put the X wave here. I mean, it's a complex correction with a small X wave, right? Or here, or on all these swings, but no triangle comes inside. What's important, and you are about to find out this later in advanced articles, part of this Trading Academy, is one rule that says that, or the channeling rule. We won't treat this channeling rule in this article here, but I only want to mention it here to stimulate a bit the curiosity. Is the so-called channeling rule that the double combination must channel against the 0 to X trend line. So you cannot, as an Elliott wave trader, put the X wave here, because if we draw the 0 or trend line from the start of a double combination until the end of the X wave, we see there's no channeling component, meaning that the market doesn't come to this trend line while forming a triangle after that. The same is valid here or here or here, but it makes sense to put the X wave here. This is the channeling component, and we can also see a triangular pattern after the X wave. A triangle that started in 2020 in January, and the market goes A, B, C, D, E, and this would be the end of wave A. Now, this being a double combination as a wave A, then it is very important to find out what the market will do next, and all the rules that we discuss in the article should apply here, especially the fact that the triangle forms at the end of such a pattern. Thank you for being here. Let's move on with a third video, part of double combinations. Still a double combination that starts with a zigzag, but a bit different one on the lower time frames. Bye bye.